This is what I spent my time this weekend on while I wasn't watching football. And most of my teams won, and it was very entertaining. But I wanted to do a more in-depth study of the 47 stocks that I follow that I think are going to be the leaders in the AI, generative AI revolution that we're about to face. And I think it's going to be of greater magnitude than that of the digital revolution because of the way it's going, the far-reaching effects that it's going to have, the deflationary opportunities it's going to present, and how it's going to change how we do everything in our lives. Now, it's going to take a period of time, and it's going to go through several stages. But what I have recognized as a result of my learnings with the school I'm going through, sponsored by Goldman Sachs, is that companies go, when they recognize a growth opportunity, they go through certain phases. And the first phase is that of projecting what that opportunity is going to mean to them in the future, then raising the funds to finance that growth opportunity, and then staffing up to make that growth opportunity a reality. We can see that if we look at NVIDIA in their past. If you look back to about 2021, you'll see that they increased their workforce, their revenues started to grow, their earnings started to grow, and then their price took off. So that's the pattern that I'm following. So I wanted to say, what are of the 47 stocks that I follow, what is the pattern that they're projecting in earnings growth, revenue growth, and employee growth? So this weekend, I went and gathered all the numbers for each of the stocks. And let me show you how it works relative to Apple. They're projecting a growth in their earnings per share, and we get this from their earnings meetings and the data that is gathered by Wall Street analysts. They're projecting in 2025 their earnings per share will go up 10.7%, 26, 13.1, and 27, 25.2. That gives us a 3-year average of 16.3. Now, their revenue is not growing quite as aggressively, 7.5, 8.1, and 15.3. Now, relatively speaking, you can see they are similar, but their average turns out to be 10.3. I like to see an average in excess of 20. That tells me that they're growing substantially. The other metric here is their employee growth. How many more employees do they have in 24 than they had in 23? Well, roughly 2% less in Apple. And you can see, though, ASML is up 16%, ACMR is up 31%, and so on. One of the stocks I really like, and what brought that came to my forefront, is that of Micron Technology. Because the semiconductor industry has been depressed in 23 and 24, their earnings are down substantially. Now you can say, yes, but NVIDIA has been up substantially. Yes, but Micron makes memory chips, and their work is done more in the EV, the laptop, the phone, and toasters and things of that nature. So their earnings are very suppressed. They're projecting, though, a 586, almost 587% increase in earnings from a negative number to a positive number, followed by a 42% and then a negative number in 27. But that gives them an average growth in earnings of 205%. Well, that's going to be reflected in their stock price. Now, their revenues are going to go up 52, 20, and a -2, still giving, though, an average of 23%. And dependent upon what else might happen in the next 2 years, this might change. Also, I'm seeing they've increased their workforce by 12%. all in all, what I'm trying to create is some means of comparing apples to apples so that I can determine which apples I want to invest in and which oranges and bananas I don't want to invest in because they don't have the averages that I'm looking for. As an example, I own some Adobe, but I'm only seeing a 3-year average growth in their earnings of 12% and of their revenues of 11%. Well, why would I invest in them if I can do so much better somewhere else? Okay? So that's what I'm trying to do, is compare these so that I can make better investment decisions and then allocate my funds accordingly. As an example, I currently do not own any SMCI because of the bad news that came out. Bad light shined on them. I liquidated, took my profits, and moved aside. But now when I look at their projected growth in earnings over the next 3 years of 33.9 and revenues of 39.7 and increasing their workforce from 23 to 24 by 11%, I say I need to get back in it. Similar with SYM. So you can see what I'm doing is comparing apples to apples, saying I have limited funds to invest. Where are they best allocated? Now, how do I then share that with my tribe? Well, I do that on my cheat sheet. This is my cheat sheet. This is the same stocks. Again, we look at their financial metrics, their asset return ratio, their return on equity, their return on capital, their gross margins, their net margins, and we come up with a rating. Then we look at a PEG ratio, comparing their earnings per share to their growth, and we come up, is their stock properly priced now? If not, what is the target price? Where do I want to buy it today based on that PEG ratio? And then I use further analysis to determine what is the price of the stock most likely to be based on their earnings, based on their revenue, based on their enterprise value at the end of 24, 25, and 26. And what if I buy it at the current price? What is the return going to be, and what is the average return going to be if I buy it at their target price? How much of the stock is owned by institutions, and what is their 5-year average rate of return, and how does that compare to where they are now? So I get a very concise picture of what a stock is doing today, what it's projected to do in the future, and where is my money best allocated. That's how I approach investing, and I think this tool just adds to it, because now what I can do is say, with the resources I have, where are they going to get me the best bang for my buck? And how is the risk related to their earnings growth, their revenue growth, and their employee growth? So that's what I'm doing. That's what I want to share with you, if you are so inclined, by joining the tribe. If you'll go to my website, Best of Us Investors, you'll see the various levels. We have a level from free to all the way up if you want to get into swing trading, what we will share our knowledge there. Our goal is to make you a better investor and collectively work together. That is to say, don't do everything based on what Kerry says. Join a community, and a community of self-interested people who want to make money. Think of it like a church. You go there and you share your resources to make for a better life. That's what Best of Us Investors is all about. That's what I want to help you do. Whether you're a novice at investing, a seasoned investor that just doesn't have access and doesn't want to spend all the money to gain access to all these data sources that I sign up for, but I leverage the price I pay by sharing it with you at a discounted price. That's Best of Us Investors. I'm Kerry Grinkmeyer. I'm a retired financial advisor, and this is what I do on the weekends when I'm not watching college football. Talk to you again soon.